been. In your opinion, when do Australians realise that they've been ripped off by their finance broker?
Yeah, it's a great question. And look, I think not all finance brokers are equal. I think slowly over time, the cowboys of the industry are being weeded out, and the regulation is helping with that. But also, I just think that now everything's moving towards more a high level of transparency. So, unfortunately, when people usually figure out they're being ripped off, it's most of the time it's too late. And from and so they've signed on to the contract and things like that, which might be unfair terms, or maybe not necessarily unfair, but not necessarily the best terms they could have achieved. So what we typically do in a situation where a client approaches us and says, hey, look, I've signed the contract with the dealership's finance is I thought it was competitive, but upon doing research, it looks like I got stung, or, I spoke to my other broker and they put me into this loan product. And so there's two parts of this. One is understanding the red flags, and two is understanding why they might have put you into that loan product. There's a bit more we could go into as to just how to avoid that. But so I think, like, if you're a customer and maybe you feel like you didn't shop around, you just went for anything that was quick and easy. Usually quick and easy, not all the time, but doesn't necessarily align with the most competitive, well thought out, well researched loan options. So in the case of a car, there's impulse buys that occur. You drive into a dealership, you fall in love with this car, and you just want it as soon as possible. And so the dealership has a point of leverage there where you just want it fast. And so typically they would only have access to one or two lenders, some cases a little bit more, but you're not going to get the same level of due diligence. Now, a broker is employed by you or engaged by you, and and they're meant to have your best interests at heart. Of course, there are outliers where brokers don't do that, unfortunately. But I would say that those people are the exception and not the rule. And so the broker is meant to find the best deal across a larger panel of lenders. Typically, an average broker would have 25 to 30 lenders. A broker that's got a really diverse skill set probably has a lot more than that. We have more than 75 lenders on our panel. So from my point of view, and that's growing. So, every time a new entrant pops up or has a really good niche that they're looking to lend into, we'll do that. So that's one part. They don't have enough lenders, so there's no way that you could possibly get a guarantee that you're getting the best deal. Typically, more competition means a more competitive deal. So if you've only got two or three lenders to choose from, then you're not necessarily going to land. Now, you could coincidentally land with a really competitive deal, but chances are, that's not going to be the case. Now, why would a broker or a dealership put you in the wrong deal? And usually that's related to their financial remuneration. So we call them broken brokers, which is the term. We've created a bunch of villainous characters on our website that people can check out, and that basically flags all of the things to look for. So the big banks with the lack of choice, and the loyalty tax and all the rest of it. And then you've got the broken brokers, and the slick Joes at the car dealerships, and then you've got the predatory style loans like the payday lender, typically smaller, but I see some of those entrants expanding into larger and larger loans slowly over time. So yeah, so they get paid commission for settling a loan. The thing is, they might choose a lender that pays them more commission. And so if that means that it's coming at your expense, they're choosing a lending product that isn't necessarily the best for you, it's the best for them. And that's really unfortunate. Our technology was designed to completely remove that. So you get the transparency, you get to decide what's important to you, you get to see all of the loan options right in front of your eyes, including what the fees are, including what the associated costs with the loan are, termination costs, all that kind of stuff. So to me, transparency's always been at the forefront. I've spoken about this at length, but I think we were one of the only industries that I can think of where you have to where you give a quote after you've done the process. Like, think about how weird that is. If you engage even somebody from the construction industry, a tradie, you say, okay, I want you to fix this leak in my pipe, or replace the tap or whatever it might be. They usually give you a quote, and then you consent to proceed with that quote, and then you pay. You know what you're getting yourself into. Now, for the most part, applying for a loan, they're like, give us all your application data, give me all your supporting documents, give me, and then we'll tell you how much it's going to cost after you've already like completed the whole process, put an inquiry on your credit file, which could impact your future borrowings. So that to me was always like, it always puzzled me, and I was like, surely there's a better way. And that's essentially the short version of the genesis of Loan Options AI. We wanted to build a system and a platform that people could get access to information in seconds. They could do it anonymously if they want to know, just to double check. Or they can provide their information. And of course, the more information they give us, the more accurate the lender rates will be, because it's looking at their specific circumstances. You essentially get you fill out one application form that's dynamic and never asks you more questions than it needs. And you can compare over 75 major banks and lenders without impacting your credit score at all. So, I guess that's, yeah.
It's a huge transformation, and I've personally seen the dark side of it. One of my family members recently lost more than $800,000 of their own money because of poor advice from a broker. And the model was, I'm going to take your money from here and I'm going to put it over there because it's good for you. But 15 years later, because of what's happening in the financial industry, it's all come to the surface. He only gave them one option, and the option was best for him. And in that transaction, they lost more than $800,000 of retirement funds. And it took 15 years to come to the surface. And that transparency, if that would have been around 15 years ago, and they said, we only have one option for you and it's in my best interest, there's no way this person would have ever said, sign me up. They would have run away. And I've been to your website and I've seen these predators, but most people, because of ignorance, they don't know what these predators look like. I've seen it with my own eyes in many different forms. As I mentioned before, I grew up in Penrith, and we used to laugh because we owned a pawnbroking business, and there was another pawnbroking business in Penrith, and they were a predator. And the only reason we knew they were a predator, because when they opened up the curtain, in the back they had a bed. And if you didn't have an item of value to lend against, you could offer your own personal services on their bed. And we've seen predators in our own backyard. But most people don't know what they look like. So from your experience, who are the predators in the loan market and how do they operate?
Yeah, I've got a fundamental issue with the payday lending space. The prevalence of them now in the online application, age, is that, people don't know what they're actually getting themselves into. They need quick access to money because, maybe their car needs a service or is broken down, or, the tire popped and, they've got a screw in it and they're going to need to replace it. There's typically a reason why someone is in this situation where they need urgent access to money. And so that's the predatory lending side that I fundamentally have a major, major issue with. And although we're not a lender ourselves, we'll never align ourselves with any sort of lender that is in that space. What I would like to do at some point is come up with a lending product that can really challenge that. We got really close to doing that last year, and then the project kind of didn't happen. But so then they've got separate regulations on those loans. They charge exorbitant interest rates, often when you actually annualize it, because they're really short terms. But when you annualize it, you're talking about interest rates like an APR of greater than 50+% with exorbitant fees. And the repayments, because they're short terms, are so high that once you take out the first one, you spend most of your, not most, but you spend a large chunk of your free wages, like your surplus cash, paying that back. So that means you almost need to keep going back to keep yourself afloat. Um, and yeah, like I said, the interest rates being so high, the amount of interest you pay back, it's really tragic when you see people do it. They also destroy your credit file, absolutely destroy them. There are so many lenders that will not lend to a client who has had a payday lender inquiry. And I won't list them by name. I probably should name and shame, but it's not in my nature to kind of, they're running a business and whatever else. I just think we need to raise the level of financial education that will help people understand, and we do our best to do it on our website. We talk about all those things. We expose them as predators of the loan space. They're effectively loan sharks, and some of them don't use security at all. So they're just unsecured. You need 300, 500, 1,000, $2,000 deposited into your account. They'll do it, but the terms are going to be hugely favorable for them. And what it means is once you start getting on that drip, you're going to make yourself ineligible for good loan products. Like, you can't then just go to a bank and say, okay, now I need a personal loan for $5,000 or $3,000 or whatever it might be. Those banks are going to turn you away because you're now the great unwashed, if that makes sense. And so your credit score is drastically reduced. And so those are some of them. I also think in the commercial lending in property, there are some predator style lenders in the private lending space. They're typically taking advantage again of people who are stuck, like they're probably doing a development or a construction, and there's a shortfall or something, and they'll come in and say, yeah, no worries, we'll solve this problem for you, but it's going to be really expensive. Here's the establishment fee. It's going to be really, a very large establishment fee. Broker puts a large mandate fee on, like for their services. And it's really just to bridge the gap. And so in a few months, when the property's built, or 6 months or whatever, when the property's built, they can refinance it, but they've cost themselves so much money. So it's really important that people do their best to do research and spend the time to calculate their costs, building costs, get access to funds in advance, so that they're not leaving it last minute. Anytime you're going to leave a loan last minute and not do your research, that's when you run into a real risk that you're going to end up with a lender or a loan product that's not suitable.
As I mentioned before, we were in the pawnbroking industry for 17 years. And so with the pawnbroking business, it didn't matter what your credit rating was, if you had one or you didn't. The most important thing was you had an item of value. And after 17 years, we started to get really smart. We noticed a trend that from about June through to September, we would get this huge influx of lawnmowers. And people would bring in their lawnmowers, they'd bring in their lawnmowers and would lend them money on their lawnmowers. Because back in the 90s and the 2000s, a lawnmower could have been worth thousands of dollars.
Yeah.
And so we would take the lawnmower, hold it as collateral, and these people would borrow anywhere between $50 and $150. They basically stated what they wanted. And we started to notice that we started to build up all of these lawnmowers, and we would lend $50. Now, the interest rate is 20% per month or part thereof, and people go, 20%? That's huge. But when you think about a $50 loan, it's only $10 per month. It's not a lot of money at the end of the day. And so we started to get smart probably after about the 12th year. And we thought to ourselves, why do all of these lawnmowers come in at around about June? Well, we asked one of our customers who came in repetitively year after year. We said, just out of curiosity, why is it that every year in June you get a loan on your lawnmower? And they looked at me and my brother and they said, well, the fact is, this is the safest place to store my lawnmower. We said, what do you mean? They said, well, the winter comes, the grass goes brown and we don't need to mow it for 3 months. And we can get a loan of $50 you're the most secure place in the area, and I can leave it here in storage, and storage is only $30. And I'm like, well, how much would Kennard's Hire charge you? And he said, it's going to be at least $50 a month to store my lawnmower. So we realised that although we're a financial business and we're holding collateral, we actually become a parking lot for everybody's lawnmowers. And they said it was the cheapest rent, it was insured and it was secured. So even we were being taken advantage of, but we said, okay, fair play. You know, if that's what you want to do and it works well for both of us, we're good. So we've been preyed on.
That's very clever on their end. Yeah, for sure. And look, there's a lot of people on the other side that take advantage, you know. We've seen it. We've seen customers come and, we've come to us. They've got inquiries with other lenders. We ask them, are you proceeding with those lenders? They say, no, we're not. You know, we want another deal. And then, so we'll find them a better deal. They'll take out our loan and then 24 hours later, take out another loan. And so there's people that know how to cheat the system. And like anything, as long as we're doing what we can and doing right by the customer, you know, you can never stop the people that are, you know, think they're too clever for the system or whatever. So, but yeah, that lawnmower thing is pretty funny, actually.
We started to see the other trend as well. People would bring in their fishing rods. And so many years ago, fishing rods were very expensive, like the reels. And these people who go beach fishing, they'd have these reels that are worth $1,000, but they'd leave them in their little garden shed with their little padlock this big. And they were forever being stolen. And they said, you know, the best thing for us is during winter is if we just come and hock the goods here because you're the safest place. Now, we're a pawnbroking business. Our job is to lend you money. It's to keep your goods safe. And if you can get around that and it works for both of us, well, more power to you. And it was in many, many different forms. Probably one of the cheekiest ones we ever saw was a lot of people aren't, I'd say they're financially disabled. They don't know how to utilise their money. They don't know how to save it. They don't know how to spend it. And a lot of parents, what they would do, they'd say to their children, they'd say, hey, the Xbox broken. I'm going to go and get it repaired. And then they'd bring it down to the pawn shop and they'd borrow $100 on it. And the interest rate's $20. But that $100 helped them survive until the next paycheck. And sometimes the parents would sign off the pawnbroking ticket and send the kid in whilst they sat out in the car. And the kids would come in and say, is my Xbox repaired? And my brother and I would be scratching our head going, the Xbox has been repaired? And the story would go that the parents told the kids that the Xbox was broken.
Yeah, that breaks my heart, eh? Far out. That's, I mean, look, people are doing tough. That's why, like, I as much as I was bagging on the, the payday lenders, like some people really need it. They really need it. So that's why but also I just wish they would do things a little more ethically. You know, it's very much they understand leverage and they're using all the leverage they possibly can, charging through the nose. And there's a good product that's trying to tackle that. It's called Before Pay. And it's really just trying to make those kind of payday lenders obsolete. You just download an app. If you're short, you can get a very small loan with no interest. It's just a fee that you pay. You know, it's kind of like interest, but it's not. But it's just way more reasonable, way more cost effective. And I just hope more people come out and try and solve those problems to give those people that are, you know, if they've got to choose between, you know, an Xbox, like hocking the Xbox in, or, you know, have food on the table, like it's a no-brainer. Of course, you got to feed your family. It's upsetting that, you know, people have to be in that position to begin with, but a lot of that, you know, there's different people that have different hardships in life, and I think when people try and take advantage of that, it's really problematic for me just as a person. So
with the payday advances, when we were scaling our business as pawnbrokers, we were looking for additional services. So we say that all services businesses in the end become a product business. So as a pawnbroker, you're offering a money lending service, short term, you know, 5-10 days. That's the goal. Within 90 days, you want to make sure that everybody's getting everything back. That's the goal. But if they don't come back, then that business becomes a product business. So now you've got a retail outlet for that. So we're thinking, how do we grow this business? Things like eBay are being introduced. So where people would have come to the pawnbrokers and sell their goods, and then we would resell them, they were selling them directly on eBay. But with eBay, you can't always get the money really fast. You might have to list your item. It might go on auction for 7 or 14 days and it still doesn't sell. So there's a long delay. So we would, with the pawnbroking business, especially in the 2000s, there was a lot of introduction of Chinese goods into the marketplace. So there used to be these Milwaukee and DeWalt power drills that builders would pay hundreds, sometimes thousands of dollars for. But when the Chinese brought in these $5 and $10 circular saws that you could buy for Bunnings, the things that people were buying had no value. So they could buy all these circular saws and these drills, but when it came time to pawn them, there was no value. They were just throwaway items. So we introduced payday advances as an additional service. And what I saw was that for people who used it once off, it was perfect. If they just got to a stage where they got an unexpected bill, maybe the child had to go to hospital and they've got to pay the hospital bills, insurances come in. If they got a payday advance and used it once, it was perfect. But the problem was they would get hooked on it. And instead of becoming a once off, it became a once every now and then, and it did become a continuing cycle. And I can see the dangers of it. And so there's two parts that people have to have that financial literacy, but most people still don't. And those people who are tending to use that service, a lot of the times the history that precedes that is they've borrowed money from family and they never paid it back. They've borrowed money from friends and they've never paid it back. And then their last resort was either pawning something or getting the payday advance. And I think the greatest benefit to that was with the pawnbroking business is if they didn't come back for their goods, there was no hard feelings. There's no impact to their credit score. It's just fair play. Okay, you didn't come back, we'll sell the goods and recover our costs. For the payday advance, as long as they had that money coming in, then the lender at that time, we're talking back in the 2000s, would get their clip of the ticket. So they were safe, but there was never any hard feelings. But the problem was when they got hooked on it. But that was, I'm talking 23 years ago. I'm sure a lot has changed since then.
Certainly. Yeah, certainly.
And there's a lot of risks with your business. I understand that now you're using AI technology to remove these risks. So how is the AI technology helping the end user?
Yeah, so a number of ways. Actually, we use it throughout our business. One is, fraud identification. We use it to detect the probability of approval, probability of settlement, but also to recommend the most likely match to the client. So it ensures that, based on historical data with people with similar information, that they don't accidentally choose the wrong product that's way off. So that's there. In terms of the fraud identification piece, like we're looking at, some of it's third-party services that we integrate with, and some of it's our own stuff that we've built. But we're also looking to we've got like a bank statements insights tool that we're going to deploy and give the clients a report on their bank health, like their spending and saving health. So there's a lot of things that we're doing, and one of it is the customer has to be aware first and foremost. So you've got to raise awareness, and that's education too. And then the second thing is we want all the decisions that we make in terms of selecting the right lender for the customer to be extremely transparent and to be documented. So we can never have a situation where a broker selected a lender because it best suits them, best suits the broker, and not best suits the customer. Some examples of that, I published a report on our business's performance for the last financial year on LinkedIn. And some of the interesting stats, we've got more than 75 lenders, as I said. We had 0% of our lenders, so zero lenders at all, that received 15% or more of our business. We had only 2 lenders receive more than 10%, and then 90%, so 68 lenders received less than 5% of our. I was just remembering the numbers. So 90% of the lenders, so 68, call it, receive less than 5% of our business. So it shows you the spread that we're using in that. And really, there's 2 lenders that got more than 10%, so that leaves 5 that got somewhere between 5 and 10% of our business. And so the spread is quite quite wide, and that's just shows that our technology is working. And the AI does remove a number of risks. In terms of credit risk, it helps identify better quality clients, operational efficiency as well. So we know to call, the client who has indicated some level of urgency, or has a certain profile. We know, okay, just in terms of prioritizing how things need to be prioritized with like an intent score, or a lead score, if you will. So we're just trying to use it because we think that it can, a lot of the stuff that a broker does is very much relationship based with the lenders. It's very much logic, and a lot of logic and reasoning that the broker's using to determine, okay, this is the right product for the customer. The AI can't have empathy, so we still need, at this point in time anyway, doesn't have the empathy. So we need brokers to really understand the human part and connect with the customers. But it can do the logic and the reasoning far, far better. And in a more transparent and unbiased way. A lot of comparison sites, especially the big ones in the country, they're totally biased. It's a pay to play game. Their lenders are paying them more money to be listed higher in the results. We don't accept any money from any lender to change the results or the outcome of who's ranking higher. It's a totally unbiased model, and it's worked really well for us. We've seen 300% year-on-year growth. So for us, it's like we certainly feel like we're on the right track, and AI is a big part of that.
I love that you mentioned AI and emotional intelligence, because for many years we've specialized in emotional intelligence. And one of the biggest challenges we found with measuring people's emotional intelligence was their own biases. And
Yep.
through the pandemic, my wife and I are thinking, how do we solve this problem? Like, AI has to be able to help us solve this. And we actually found a piece of technology that was driven by AI, and it can actually measure your levels of emotional intelligence. So the technology, what it does is it listens in to your voice frequencies. And hidden inside of your voice frequency is different frequencies. They can range from 1,000 hertz all the way down to 0 hertz. And it can actually predict your levels of emotional intelligence, what stresses you, and which areas of your life need more attention based on the brainwave frequencies. So I'd love to see one day that financial health and emotional health comes together, and that people can even measure their emotional intelligence when it comes to getting a loan. Where am I panicked? What are my fears?
Yeah.
What are my
Yeah, what's
blind spots?
my understanding? Yeah, I
Yeah.
had a great chat with Betsy Westcott, who's a financial coach. She's really lovely, smart lady, and she spoke about the psychology of money. Is people have these bad behaviors associated, and they almost have like money PTSD, because they, let's say it might be they saw their parents fighting over money when they were young, or they have fights with their significant other, now that they're, whatever it might be, there's these things that occur and so people develop a negative relationship with money, so they kind of just ignore it. But I think the correct strategy is to really learn as much as you possibly can, so that you can make good decisions, and you're armed with the tools, right? You won't try and build a house. I mean, you could build a house with just a hammer and a set of nails, but the nail gun's gonna allow you to put the frame up much faster, right? right tool for the job. And if you don't have the tools in your arsenal, you're just going to be, you're going to fall victim to the system. Like you're going to find these, the car dealership that is trying to, pull the wool over your eyes. You're going to bump into one of those broken brokers, or, you know, the suits at the bank, whoever it might be. You're going to bump into somebody who doesn't have your best interests at heart, or isn't, in the case of the banks, it's not necessarily, because they're obviously very, very heavily regulated, but they only have one product to offer you. It's their product, so they're not looking at kind of what's available there, and they can't look you in the eyes and say this is the best outcome for you, because they don't know what's out there. So that's, yeah.
With that financial blueprint, which we all have, it's developed in the first 10 years of our life. So in the first 7 years, we call it the imprint period. And most people, when they're from 0 to 7, their parents have financial problems. And I remember for me, the perfect example was I'd hear these things from my parents: money doesn't grow on trees. It's okay, they come from a wealthy family. It's okay, they work for the government and they've got a guaranteed pension. We are just workers. And what we've got to do, we've got to tighten our belt. And I always heard this phrase: we've got to tighten our belt, we've got to tighten our belt, we've got to tighten our belt. And it wasn't until I was in my 30s that I realised that had been imprinted upon me. And I turned around to my wife, and we're living in Dubai. And she said, "Husband, can you take me to the movies tonight?" I said, "We can't afford it." She said, "What do you mean? It's the movies." And I said, "Money's tight, we've got to tighten the belt." And she said, "What's that supposed to mean?" And I said, "Oh my gosh, I sound like my mother." And so I rang my mum and I said, "Mum, did you used to say this to me?" She said, "Yes, because in the 80s, when your father and I bought plant equipment, there was a recession. It rained for a whole month and we had $500,000 in loans at 18% interest. And there was no money coming in. And we had to literally tighten the belts. We had to stop the spending." But she said, "Why don't you talk to your grandmother about that?" So I went and spoke to my grandmother and I said, "What's this tighten the belt business?" Oh, she said, "That's because we come from a poor family." And I said, "Well, what happened in your family?" She said, "Well, when I grew up, your grandmother or your great-grandmother and your great-grandfather split up. There was 6 children, and your great-grandfather left and abandoned his 6 children. And we had to tighten the belts, literally, because we had no food to eat and we were becoming malnutrition. And we're shrinking, but the clothes are remaining big. So we literally had to tighten the belt, literally, to keep the pants on our bodies." Now, that was 4 generations. It had passed on from my great-grandmother to my grandmother to my mum. And then I'm saying it in 2010. We've got to tighten the belts. And so these financial imprinting occurs in the first 7 years of our life. And then our financial values are locked in by about the age 10. And so that's the root cause, this area, the blueprinting. But then we have these significant emotional events. And there's one thing that's really interesting when it comes to money is we say that if there's an unmet need in the past, it becomes an unwarranted and unrealistic need in the present. So for some people who were deprived of money when they were young, the first thing that they do when they get it when they're older, they got to spend it. And so one of people I know, he said, whenever money came into our house, our parents would say, "Spend it as fast as you can before somebody takes it away." And so a pattern for him was whenever he got money, he just spent it straight away. But when it came to the opportunity to get a loan, he would often not read the paperwork. He wouldn't go into all the fine details because he just wanted the money to spend it straight away.
Yeah, to spend it. Yeah.
And I
Yeah,
think
it
if we can
is.
all come together and work the
It's
mindset.
crazy. Yeah, you just think like the mind is a sponge, especially when they're younger, and the brain doesn't fully form until 25 years of age. And so there are, even if you had, some bad habits, if you want to educate yourself, you can. It's never too late to change those behaviors. It's hard to get out of those patterns for sure, but my advice would be to try, and even if it's just one article a week on how to, how to manage your money better, or download a spreadsheet. Like I know Microsoft Excel and Google Sheets and all of them, they're free templates for budgeting. Just go in there, put your income in, put all your recurring expenses, and it tells you how much free cash you have. Really simple. It's a 5-minute thing, and then you go, okay, this is how much money I have to spend, and I want to put aside, $500 a month, 1,000, 3,000 a month, whatever that number is. And so then that leaves you with a number that you're able to spend, and you just divide that by 30 days or whatever. Doesn't take long, but it's a great exercise. So then you go, okay, now if I'm allowed to spend $100 a day, as an example, if I go over that, I know that the next day I'll have to spend, if I spend $130 because I went out with my friends, now I've got to spend 70, or to make that deficit up. So that's very interesting to hear your story, the tighten the belt thing. All of those analogies or like sayings have come from that kind of depression era, right? Like it's quite a few generations ago, but a lot of sayings came out there. We just say them because we know what they mean, but we don't really think about the origin of it, right?
I remember the best one must have been 2012. My daughter was born, and my mum and dad and my grandmother came to Taiwan to visit us. And whilst my mum and dad were here, they said, "You need to have a talk with your grandmother." And I said, "What about?" They said, "We think she's an alcoholic." I said, "You think she's an alcoholic? What's happened?" They said, "Well, we went on this Wendy Wu tour through China, and it was for 20 days. And each of us got a ticket for a free alcoholic drink at the bar every night. So 20 days times 3 is 60 drinks. And mum and dad said, we didn't want to drink at the bar, so we gave the ticket to your grandmother. And she's having 3 beers every single night for 20 days. I said, well, that's a lot of beer for an 85-year-old. They said, you need to have a talk to her. So I went and talked to my grandmother and I said, Mother, Mum and Dad seem to think you might be an alcoholic. She said, why? And I said, because on the Wendy Wu tour, you were drinking 3 beers a night for 20 days. She said, yeah, I did that. And I said, can I ask why? And she said, you can't waste food. And I said, let's just get something correct here. Alcohol, beer, is not food. She said, food and beverage, you can't waste it. And I said, well, where do you get this from? And again, she goes back to that same story. Well, Daniel, when I grew up, your great-grandfather walked out on us. There was 6 children, and your grandmother was a janitor. She only had a janitor's wage, and she was cleaning the school. There was no extra money for food, and so we couldn't waste food. So 80 years later, she still has the same food values. You can't waste food. There's 3 alcoholic beverages a night, and there she is slamming down the skewies in China because she can't waste food. I said, grandmother, it's 2012. You're financially secure. You're stable. You don't have to worry about money. But see, even with all those things in place, those values and those belief systems are locked in, from those traumatic times. And I've seen it in my family. So if anybody sees me drinking beers, and I'm going to say to you, you can't waste food and beverage. Who taught you that, you bloody alcoholic grandmother? Now, I think a lot of Aussies are thinking about money. It's a hot topic. When should Aussies start exploring their loan options?
Yeah, that's a really good question. There's many different reasons why you should look at what's available. So we're seeing a lot, especially since all the rate rises, we're seeing a lot of debt consolidation loans, and they're doing it for various reasons. Also refinancing of existing loans. But yeah, one of those things is, people's interest rates on their homes went up, or even if you don't own a home and you're renting, your rent probably went up. And so they're looking for other levers that they can pull. And so if they have a few credit cards, maybe they don't owe too much on them, but they owe something, or maybe they owe a lot, it doesn't really matter. If they just pay the minimum, they're going to be paying that off for 40 odd years, 40 plus years, because that's how the credit cards are structured. So every now and again, we see a customer, they got a couple of credit cards, a personal loan, a car loan, and it just becomes really hard for them to manage. All the payments come out on different days, and they're paying different interest rates on different things. And So, we could potentially in that scenario use the car as security to get a lower rate, but consolidate all of the debt so they're not paying credit card interest rates and potentially they're paying like a single digit rate um, for all of their secured and unsecured debt. And we can put the loan term set at 7 years or 5 years or 1 year or whatever they're comfortable with. But most importantly, it's not going to be 40 years. So they're not going to be buried in debt perpetually. And even with all of that said, the repayments will actually be lower than what they're currently paying. So we had a scenario only this week. Client consolidated a bunch of debt. Basically, after we did the consolidation, they were going to be saving $600 a month and paying all of the facilities off inside 6 years. So for me, that's a win because the customer's saving all of that money, $600 a month multiplied by 6 years. I mean, it's a big number, and now they have $600 back in their budget, and they can put that towards a holiday or they can save it. All those kinds of things. Refinancing is an interesting one because you might not think that we would be doing a lot of refinancing given rates are higher now. But what we're seeing there is people took out a loan, even if it was 12 months ago, 18 months ago, or longer, um, and specifically for there's two specific reasons. So one reason would be they took out a loan and at the time they didn't shop around. So they're paying more than they need to be paying, and we can get a more competitive rate because obviously we compare so many lenders. So that's one. Two would be the fact that maybe they took out a loan with a lender that was subprime, but now they've built back their credit rating, and so we would refinance it. And the third one, which is the less obvious one, but let's say you took out a $50,000 or $60,000 loan for a car. It doesn't really matter what that amount is. The concept is going to stay the same. You took it out and maybe you took it out over 5 years or 7 years or whatever you took it out, whatever the loan period is, and you've paid a large portion of that down. With car loans or any other loans, typically the repayments are fixed unless you've got a variable rate. And that's not very common in asset finance. It's more common in home loans to have a variable rate. So now that you've got, say, half your balance left or less, you're still paying the full amount. To free up some cash flow, what we're seeing customers do is say, hey, look, I took out a loan for 50. I only owe 20,000 on it now or 25 grand on it now. If I refinance it and stretch the term a bit, how much can I lower my repayments by? And all of a sudden you get a client that has a repayment of $1,300 a month, whatever it might be. Now it's, $450, $500 a month. And so they've got this free cash. And it's not always the right solution because obviously if you extend the term, then you're likely to, have to pay more interest in the long run. But if it means that it prevents you from having to access payday loan facilities, or, if it means that you're eating into all of your cash reserves or you've got no cash reserves, it's a very, very good strategy to free up cash flow. So that refinances, very good. Debt consolidation, very good. You may want to take out or upgrade, your car or whatever it might be. I put those as secondary because they're wants. Maybe you do have a car that's costing you too much. One of our staff members actually is, for a few weeks in a row was saying, sorry, I'm late, car's broken down, waiting for the tow truck, and she sent it to the mechanic and paid a very large bill, and did that a few times before. She's like, I think I just need to buy another car because this is costing me more to maintain it than the repayments would cost me. So yeah, and if you have a home loan, we partner with some of the best mortgage brokers in the country, and people that come in off those fixed rate, the fixed rate cliff and things like that. Or if you just trust that your bank's doing the right thing by you, the loyalty tax is real. It's just as real in the finance industry as it is in the insurance industry. I didn't, for example, my insurer didn't make a single claim. None of my circumstances changed, nothing. My insurance is up in terms of cost by more than 70% in 1 year. Now, if I just said, you know what, I'm going to pay the loyalty tax here, I'm sure that's the cheapest. They were the cheapest last time, and I thought I was getting good value last time. If I didn't go through that exercise, I would have paid 70% more than I needed to. And then I just went and did my homework, did my research, compared. The problem is in insurance, it's not as easy to compare because some of those comparison sites don't aggregate all of the best insurers, whereas our website does aggregate all the best loan options. So it makes that research process much better, much easier. But the key thing there is do your research. I was looking for some room in my budget, and by the time I cancelled unnecessary subscriptions that I never use anymore, shopped around in my car insurance, my wife's car insurance, refinanced my mortgage, and a couple of other things that I just went through, and like these are the major expenses. My health insurance, my electricity and gas, like my home broadband. I just went through all of it. Like you just find more than $1,000 in your budget a month. Like it's ridiculous how much money you can find if you really focus on it. So I would say the best advice I could give to Aussies would be you should do that process, put down all of your recurring expenses. You're going to have one-offs, and maybe you should petition a little bit of money so you can go out with your friends. I'm not saying don't live your life. I certainly love to go out and have dinners, and I'm a bit of a foodie myself. I'm not saying don't live your life. I'm just saying just be accountable to a budget, and that way, if you don't have any guardrails on yourself, you will just spend it until the bank says there's no more money in there. So, but if you put some guardrails, if you set some goals, you can achieve them. And if a loan forms part of that, or if because you want to grow your business, or because you want to refinance your car, or you think that we can free up some money in your budget, then obviously check us out, or check a good broker out. If you don't want to use us, that's cool, but find a good one. Find someone that is going to be transparent and upfront with you. If you ask them what the interest rate is, and they deflect the question, this is the number one thing with dealerships. If they deflect that question, you're not dealing with somebody who has your best interests at heart. That should be a reasonably easy question to answer if they've got your interests at heart. So